when you're in an audit and you have that 30-page cost seg study that explains all the calculations and everything, if you slide that to the auditor, it answers 99.9% of their questions.
Welcome to The Real Deal, a commercial real estate investing podcast. I'm your host, Aman Shahi. There's a ton going on in the world right now, and much of it impacts real estate investors. The Real Deal podcast will take a look at what's happening and how it influences you as a real estate investor. Each episode is a 20-minute segment dedicated to distilling the day's most important news, so you can stay up to date on what's going on in the world and how it might affect the commercial real estate market.
Welcome back to another episode of the Cashflow Capitalist Show. Today, we have a very special guest, and he's going to talk about cost segregation, depreciation, what that is. Everybody's talking about it. Welcome, David.
Thank you, Aman. Thank you for having me. It's a pleasure to be on your show and seeing you in all the local networking real estate events. I'm happy to add some information if I can. Yeah.
All right. Give us some introduction about yourself in 30 seconds. Who you are.
Who am I? I just turned 60 a couple days ago. Grew up in Maryland, went to school in the Carolinas, and came out years ago. And pretty much my professional life has always been in financial services. I did sell global credit insurance for a while and help with accounts receivable and global credit. But about 3 years ago, I started working with this company, and a friend of mine kept telling me it was a wonderful opportunity like 5 years ago. And I finally came. I'm very happy with the change. It's I've always been helping people with something financial that can benefit them. And the more I understood cost segregation, which is a bit confusing, the more I realized how it could impact the bottom line for many real estate investors. So happy to discuss.
So what is cost segregation?
Cost segregation is just a fancy word for breaking down the cost. Like if you bought a hamburger, you can buy a hamburger, or you could buy two all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. You're too young to remember the jingle that us old guys heard on the radio and on TV every day of our lives when we were young. But cost segregation is just taking that building, if you will, that hamburger, and breaking it down into all the specific costs. And the reason that you do that is because the tax code allows certain parts of the building to be depreciated faster. And it's just a simple concept. I mean, if you could get a deduction over 39 years or get it over 5 or 15 years, that's a benefit. You're depreciating the building faster. But the tax laws changed in 2017, and now you can get like 20% of the building, which makes up those 5 and 15 year properties. Can be accelerated into the first year, but that's I'm getting ahead of myself. But cost segregation is simply breaking things down to their cost, and by knowing the cost of the molding at the crown and the baseboard of the wall, the molding around the window, the cost of the ceiling fan, the mini blinds, the cost of all the plumbing that's going to the washer and dryer, that all qualifies for 5-year property, like cabinets, carpentry, cabinets, laminate flooring, carpeting's a big one. But basically, if you can just know the cost of something, then you're able to apply it with very favorable tax code. The issue is trying to find out what the real cost of it is, and then being able to defend it if it's audited. And that's the important part of it.
So you mentioned something about 5 years, 15 years, and what that is, and what was the 2017 tax cut laws?
So every building is either a 27-year asset, 27 and a half year asset, or it's a 39-year asset, the whole building as a unit. And most people do straight line depreciation. It's pretty easy. Whatever you paid for that building, if people pay monthly rent and sleep in it, monthly rent, it's a 27.5 year depreciation. If it's an Airbnb, short-term rental, a motel, hotel, any other retail, commercial, self-storage, any other commercial property, that's 39 years. So you can take the whole building at 39 or 27 and a half years without a cost seg study, but it's the cost seg study that allows you to break down all those costs to be able to do 5-year and 15-year. The 5 years, the internal components that qualify. The 15 years are the external, outside of the building. That's driveway, sidewalk, landscaping, curbs, all those costs.
And we always excluding the land.
Yes, thank you. I missed that. Correct. Yeah, land is not depreciated. So, you have to, and that's what the CPAs do. I mean, we're a national company. We rely on the CPA, the tax professional, to do what they always do anyway, which is give us that local land versus purchase price improvement allocation, because you take out the land and everything else is what is cost segregated. Yeah.
So, correct me if I'm wrong. So in traditional depreciation, you are taking the value of the property divided by 27 or 39, so residential or commercial, and taking the value every single year. In traditional depreciation,
yes.
But in cost segregation, you are doing the more like segregated study of different so many years and like accumulated together.
Yeah. Yep. Yeah. So you can take the whole building and divide by 27 or 39. That gives you an annual deduction, and it's prorated. If you buy a property this year in the middle of the year, if you do straight line, you're only going to get half of your normal depreciation. But cost segregation method of depreciation, first of all, it's not prorated. If someone has a lot of income in their passive income or active income from rental properties, if they can close on the property by the end of the year and collect rent in the calendar year, that allows them to depreciate that property either way. But the cost segregation method is a lot more deductions. Again, I've studied well over 100 properties in this area and other parts. I help clients all over the country. There's more than 100 of me around the country that help, and we have a network that we work together. But basically, pretty much every property that I've ever studied, it's very rare that 20% of the property, take out land. What I'm saying is what's left. It's very rare that 20% of what's left is not in the 5 and the 15-year property. Most people can probably predict they're going to find 20% of their property could be in that 5 or 15-year bucket. And then now we can talk about bonus depreciation. You asked me about the Tax Cuts and Jobs Act in 2017. Prior to that, bonus depreciation is okay. All right, back up. This is confusing. So 20% of the property is going to be 5 or 15-year asset, right?
Yeah.
And then historically, you would take the 5-year assets, which is most of it. There's more 5-year property. That's the cabinets, the carpet, the linoleum. There's a lot more 5-year property than 15-year property in multifamily anyway. If it's a commercial building, you got a lot of parking lots. There's a lot of 15-year. But basically, the value, let's say a $1 million property, they've got $200,000 in 5 and 15-year assets. Probably 80% of it is in the 5-year, and very little's in the 15-year. But historically, what you would do is $1 million, 200,000. Let's say 150,000 of it is 5-year property. Historically, what you would do is you would separate out that 150,000 and take it over the next 5 years. And the same with the 15-year property. You can take it over 15 years instead of over 27 or 39. That's a benefit, right? 2017, the Tax Cuts and Jobs Act changed everything. They gave it, prior to that, there was 50% bonus, but only on new construction. What that means is any 5 and 15-year property in a new construction, you could get 50% of the value of that applied against your income in the year of the property first being put into service. The Tax Cut and Jobs Act of 2017, September 26, actually, it changed bonus depreciation and made it 100% for not just new construction, but for existing, you could call them a used building. So that was a big change. That's a huge deduction. Anybody that has a property they put into service from September 27th or 8th of 2017, when the Tax Cuts and Jobs Act occurred, through the end of 22, if they did a study today, they would still get 100% of that applied against their next year's taxes. If they put the property in service this year in 2023, they get 80% of that number applied against their taxes today. And the other 20% of the 5-year product would be taken over 5 years, and the 15-year product will be taken over 15 years. So the bonus depreciation has been a very big victory for people that are making good money on their real estate and looking to maybe drop themselves in a high income tax year to a lower bracket by simply applying the study. When's a good time to do a study? It's when you need one. When do you need tax relief? Somebody just buying their first property, they may not have a lot of income to offset. So when I was talking to Andy, who we know from our network meetings, and he kind of made it clear to me. He goes, yeah, I think the easiest way to explain it, and I'm learning from my clients, he's saying, when someone gets around $10,000 or $15,000 of income on their property, that's probably where they should start to look at it, because if you can pull a $50,000 tax savings, it could wipe out that income for the next 3 years, 15,000, actually three and a quarter years or whatever. But it is a tax strategy. It's not right for everyone. Everyone's tax situation is different. We never recommend everybody should do it. We'll run an estimate. I push for great pricing. And the most important thing is the accuracy. Nobody wants to spend money knowing at least they're going to hit a certain number. So we push for great pricing, very accurate estimates, and we simply engage if they and their tax pro discuss it. I don't think it's my place to ask all these other questions about income and everything. If their tax pro says, yeah, this would benefit them, that's all they need to know.
So since you mentioned what is the right time to do the cost segregation when you need it, but I cannot remember, I think around last year we talked about it. You mentioned you need to do cost segregation when it's a second or third year of the property. So
there's a benefit to doing it earlier. Is that what you're asking?
Yeah. What is the right time? Should the people buy it during the first 6 months, or they have to wait 1 or 2 years to have a proper right time so IRS won't audit them?
If you buy a property and you do a cost seg study the first year you buy it, then you just apply all those numbers to the depreciation schedule, the cabinets, the carpet, all the study numbers go right in depreciation schedule. It's very clean, and you get a very good price. Well, you always get a good price on the cost seg with us, but you don't have to do any extra accounting if you apply it the first year. If, for example, you've had the depreciation schedule with straight line depreciation 1 year or many years, you have to do what's called a 3115 form. It's an IRS 3115 form. It's called a change of accounting form. And all it does is it takes all the math from straight line out of the depreciation and repopulates all the cost seg numbers that we come up with. But it's a lot of math. Tax professionals hate to do it. I've seen them charge $1,200, $1,500 to do one form. We do it for $750 as a courtesy because we have software that helps plug it all in. We just ask the tax professional to fill out a page and a half questionnaire. But that reduces that cost. So if somebody doesn't have a lot of income the first year they buy the property, I don't think they should. I don't think there's a reason to do it that year to save $750, if you follow me. Now, if they're a year or two in and they're starting to get 15 grand or more of income where they're starting to be taxed on it, maybe that's where it would make sense. But running an estimate on the property and seeing the value of cost segregation for that specific building is what would help with that decision. I hope I answered your question. Sorry, I got off track.
Yeah, you did. So, what if you talk about bonus depreciation? What is bonus depreciation then?
Oh, it's just pulling it all forward. It's front loading it. Like I was saying, before 2017, and you can still do this, nobody does, but you can take, let's say that $1 million building has $150,000 of 5-year property. You can take that you used to take that deduction, that $150,000 of 5-year property over 5 years, and that'd be a $30,000 faster deduction for 5 years instead of taking that same component over 27 or 39 years. So bonus depreciation is whatever the current tax year law says is available for pulling it forward. It used to be, like I said, September 2017 through all of tax year 2022. If anybody put a property in service in those years, they get all of the 5 and 15-year property that we find in the study, typically 20% of the property after taking out the land value. All of that could be applied as bonus depreciation next tax year. Again, if they put the property in service, and this year, 2023, they get 80% pulled forward in the current tax year. But the other 20% of those 5-year property, the value of the other 5-year property, the carpet, the cabinets, all that stuff would be taken over the next 4 years.
So I also saw many people, mostly in syndications, when they invest let's say 50 grand in a property, after 5 years they sell it, they also do the bonus depreciation. Do they have to do the recapture? Do they have to give
let's talk. Yeah. Let's talk about, let's talk about the one thing you would never do with Cost Seg is Cost Seg a study that you're going to flip next year or the next 2 years. You just don't do it because there's two tax benefits with two benefits you get by doing cost segregation. The first is, yes, you do reduce your taxes in the year of the study. And that's the main reason a lot of people are real excited about cost seg. But whenever they sell that property that we study, it does get recaptured. The tax benefit does get recaptured. So what you want to do is hold the property for a long enough period of time so that you can minimize, it's called minimizing the recapture. Basically, when you sell a property and you're going to get taxed on the gain of the property, it's very logical that the carpet that we studied 3 or 4 or 5 years ago that we said was worth $100,000 in that multifamily whole property is now worth maybe $40,000 or $30,000. Actually, I talked to our CEO over lunch because I was very curious about this because people need to know that our CEO thinks that if you've got carpet in your building and we say it's worth X, it's probably worth a third less in just 3 years. That's the useful life of carpet. It really loses value quickly. Laminate floors, he thinks, are more resilient. You could probably, if you hold the property, if we say all the laminate flooring in your building is $100,000, you could probably write it down 25% in just 3 years. And you'd have to do a lot of digging and research on the useful life of different components. But people can reach out to us if someone studies a property with us and 3 to 5 years later sell that property and they're going to get the recapture, because cost segregation, what it is, it's just an interest-free loan from the government. You owe the money. The government is just allowing you to not pay it right now, which is a great thing for the property owner to have more cash flow to be able to invest in other assets and pay off debt and everything else. But the owner needs to know they're going to hold the property for 3 years minimum. If they can hold it to 5 years, let's say that go back to that same property of $1 million, where it's 200,000 of 50,000 of 15-year property, $150,000 of 5-year property. In 5 years, that 150,000 is not worthless because if the carpet's still on the floor, it's still being used. It has value when you sell the building. But there's a whole strategy to how you can defer taxes the year you do the study. As long as you hold the property for at least 3 years, whenever you sell it, it's logical that everything we put a value to when you bought it, especially the flooring and the window treatments and the ceiling blinds, ceiling fan and the cabinetry, it loses value. It's 5 year. It's called 5-year property for a reason. It's not supposed to last 39 or 27 years. So when you sell that asset, it's very logical to take what we said the cabinets were so many years ago, write that down, and then when you sell the property, have the gain in the real estate be shifted to it's logical that must be land value then, which has better tax treatment. So I don't know if that answers your question, but I see it as two benefits of cost seg. You get the tax relief now, and when you sell the building later, the data that we have can help with paying less taxes out of the gain. And you should be holding real estate for 3 to 5 years. Most syndications, I guess, have that format anyway. So.
And as I'm also doing like up to like 7 years too. So I'm also going up to like 10 years too. So do you say that like 7 or 10 years is a optimum time?
I've never really looked at it that way. I, I mean, that's a great question. I've never even thought about it. I just know that if you can hold at least 5, you're getting the full tax benefit of a cost seg study, and you're still going to get a benefit in 3 years. But the other thing too, our cost segregation company, CSSI, we include the replacement costs of all the major building systems when we do a study. I've seen most cost seg companies don't do that. So when we do a study, we're going to tell you what you paid for all these components when you bought them, which helps with the depreciation deductions. But the other thing we do is we tell you what the cost to replace your AC system is, the cost to replace your roofing, the cost to replace your windows, the cost to replace all these things. And most tax professionals know the rule of 30%. In 2014, the IRS finally explained the difference between capitalizing and expensing. And it's a great question, right? I'm spending 15 grand on my property. Can I write it off this year, or do I have to take it evenly over 27 or 39 years as a deduction? Obviously, expensing it today is a huge benefit. Inside of our cost seg studies, we include replacement costs. Let's say you're considering replacing all the windows. As long as you're not doing betterment, as long as you're not going from single pane to double pane, as long as you're doing single pane to single pane, and let's say the replacement cost, we say that your window system of your building and the replacement cost is, say, $150,000.
Yeah.
As long as you spend less than 30% of that in a calendar year, you can expense it.
Oh, that makes sense.
I see this done wrong with a lot of tax returns, and I can't say anything because we're referred in by the tax professional, right?
Yeah.
But my job right now, and that's why I'm doing all these courses, because I want the investors of the properties to take a little more ownership, if you will, of their deductions. I mean, if you've got let's say you've got a triplex and somebody moves out and you're replacing cabinets, carpets, and flooring, that's less than a third.
Yeah. Of all the costs.
I believe we would consider that an expense, even that entire, it depends on what was done in the renovation, but mostly it's 5-year property. It's carpets, cabinets, linoleum,
So if we talk about that expense, can we write off that expense as a tax write-off, or we have to go through as a depreciation method? Or cost segregation?
No, it's a straight write-off. You don't even need me.
So
here's the thing. Here's the thing. It's called the rule of 30%. At least that's what we call it because it's easy to remember. But that's what the tax code said. If you have 3 buildings and one of them needs to be re-roofed, you can expense one of them each year, or 30%. They gave an example of carpeting in a building. Hey, if you've got 8 units and or if you have 4 units and replace carpeting in 1, can you expense it? Yes, it's less than 30%. I just see a lot of improvements capitalized where they just group them and put them on the return and take 1/27th or 1/39th a year. And I believe cost segregation is a great tool, but I think what's better is knowing what you can expense. And let's take it to, let's say you don't have 3 AC units on the roof. Let's say you only have 2. And let's say we, in our study, and we stand behind our study if it's ever audited, let's say we say the value of the AC units, both of them together is, I don't even know what they cost, say $80,000 for both of them. Your tax pro has a problem because there's not 3, there's 2. Without a cost seg study, there's no way that property owner would know that the replacement value is $80,000. That means you can take 30% times 80%. You could do a $24,000 repair and expense it in that tax year. But I'm telling you, most AC stuff I see is always on 27 or 39 year. And the IRS really only explained the difference between expensing and capitalizing in 2014. I mean, it was 9 years ago. But most CPAs, most tax professionals look like me with gray hair. And I don't think some of them, to be honest with you, really want to know a lot of the new stuff. They're about to retire. I mean, I enjoy what I do. I don't have a problem making these calls and going out, doing site visits, taking pictures of multifamily. I mean, I enjoy it. But if I didn't enjoy doing taxes all day, but I was making good money from everybody who assumed everything was done correctly, and I didn't have to study anything, I mean, I think that's what I see a lot. I'm just being honest. So finding somebody that knows the tax law that's young can be huge.
But there's a lot. Some people also say that, like, they have to do the even recapture. They have to, even if they do bonus depreciation, they would have to pay the IRS the return money in the recapture after 5 years. What do you want to say? Like, how much they have to give them? And
let me put it. Yeah, let me put it this way.
Can you give it by using an example, like with the numbers?
Well, the quickest answer is the worst thing that can happen is whatever the cost of the study is, the absolute worst thing to do is the worst thing that happens is you throw the money away. You should have never done the study. You're not going to lose any money. Basically, whatever you got in tax relief is coming back to the government. So you're just not ahead. You don't lose money. You're just not ahead. So the longer you can hold the property, we would say after 3 years, you can pencil out the numbers and they all look really good at that point. So
got it. Yeah,
I don't know if that answered your question, but
yeah, it does in a certain way. But it was like because many people still have an idea they have to return the money, how much they're gonna get back in the depreciation or something like that. Because many people don't even have an idea about cost segregation. What is cost segregation? What is depreciation? So when you start talking to them, then you realize it's just not one or two different lines. It's a lot of stuff that we can talk about for an hour or so. We have like so many different questions in our mind.
I know. When I first started getting into this business, I had a lot of questions. I was confused for a while, before I could even decide this, But yeah, there is a misconception that it's a one size fits all thing, and it's definitely not. It's definitely not. There are definite situations you would never do this if you know you're going to sell that property.
Yeah,
you don't do it. Now there is a unique situation that if I'm about to do an estimate on one of those now. Somebody bought it 5 years ago, but they are planning on selling it right now. And we're going to go back and capture all the depreciation they missed over the last 5 years. And that's going to be an interesting estimate to see because sometimes they look real good and sometimes they don't. But generally speaking, you want to hold that property 3 years. Yeah.
And what are the chances IRS can audit them the moment they sell it?
Well, here's our numbers. And I asked that question before I got hired because I knew somebody smart like Aman would ask me that question. Our numbers are, we're the original. By the way, the CEO of our company was involved in the first case. He was a building engineer. We're just a bunch of analysts and building engineers at corporate. I'm just a mouthpiece, but the people, they're analysts and numbers people. But basically, Columbia Hospitals had a giant tax bill. And, they have 100 different hospitals, I read. So anyhow, I guess apparently in that meeting, nobody will confirm or deny if he said, well, if carpet lasts 5 years, how come we're depreciating over 39? It's not logical. and we don't, it's just a joke in the company, but basically it became tax code. He saw how much taxes that Columbia Hospitals saved. Their CPA firm, brought him in, and he founded the company. Anyhow, since then, we've done more studies than anybody. We've done 45,000 studies. We've only been involved, according to him, in 15 audits personally. Mm-hmm. See, when you're in an audit, and you have that 30-page cost seg study that explains all the calculations and everything. If you slide that to the auditor, it answers 99.9% of their questions because out of 45,000 studies, they're all in place and they're all perfect according to the 15 audits that we successfully navigated. We actually have a system of how to handle the IRS, step by step, because we've had it happen a number of times. Most of the time, it's just a simple question or two on the phone. But one of them, they really wanted the guy. And the CEO was joking at our national meeting because That guy kept emailing questions about studies for 3 years. He said, not 2, 3 years. And then he laughed. He said, but toward the end of the audit, the auditor was just asking him questions to learn about cost seg. It wasn't anything to do with the audit we were involved in, but we felt obligated to reply and stay in good graces with the IRS, as we should. And one of our agents has a friend in the IRS, and he pointed at one of the CSSI studies, and he goes, oh, yeah, if we see those, we're not going to bang that for a nickel. We're going to look for other stuff. So being audited over this is probably the least of someone's concerns based on what I know. But when I got into the business, it was something I was very curious about.
Mm. Oh, wow. That's a lot of information in one day.
Yeah, sometimes it's good to break this stuff down over several conversations and cups of coffee. But yeah, the most important thing about cost seg is, are you in a position where you could really benefit from paying less taxes? Time the study if you've got a number of properties, pick the property that you think you're going to keep for at least 3 to 5 years. Pick one that you paid the most out-of-pocket money for, because that's going to give you the biggest return on your tax relief. And this is something a lot of people don't know, is you can apply the depreciation deduction on that one property against all the real estate income. A lot of people don't know that. And that's why this is a very popular strategy for people who have a number of properties, because they can buy a new property at the end of each year, cost seg it, pull that $200,000 deduction and wipe out $70,000 worth of income tax, because they haven't earned any money on that property yet. But it applies against, all the other properties.
And,
I don't know if that.
And I think you can also do towards your active income, right? Like if you're an engineer or doctor or something, that you can also take as a tax benefit.
Okay, this is a gray area that I'm not supposed to talk about because I really don't know a lot of it, but I'll tell you what I do know. Being a real estate professional is a really wonderful thing if you can really document all those hours, because then you can take these passive, deductions against the active income because you're in the real estate industry. The only other people that can do that is a dentist if he owns his own building. Somebody like that. Real estate professionals, most people in a syndication. Well, I don't know. I don't want to misspeak. But there is an opportunity with short-term rentals, because with a short-term rental, you can actually, that's W-2 income running that business. And there is a unique situation where you can apply the passive deduction against the active income in that short-term rental. And a lot of people are doing that. And you mentioned QIP when we first were setting up the call. And QIP is a really great tax strategy for a commercial building. It does not work with multifamily or single family rentals. It only works with short-term rentals because they're 39-year assets. A lot of people should be aware, if they have a short-term rental, make sure you're depreciating it on your schedule as a 39-year property. It's a slower depreciation because it's a business property, I guess. It's not 27 years. That's an easy thing to be audited over. If the IRS could just pull up Airbnb in all the locations and just do a reverse search through all the tax returns, anything that's not 20, anything that should be 39 that's 27 is an easy audit. That's just something people should know. I'll mention that. But in the same way that a commercial building, a strip mall, a commercial building, strip mall,
offices,
self-storage center, hotel, motel, whatever, all of those are 39-year assets. So is an Airbnb. If you can put that house and collect rent as a short-term rental before you do any renovations, you get QIP. That property, to qualify for QIP, has to have been in service as a commercial property before. And what's the big deal about QIP? Well, QIP turns other things that you do to the property, putting in a divider wall, doing some plumbing and electrical work, expensive stuff. If you can get all of that to be considered QIP, which classifies it as a 20-year asset, it then qualifies for bonus depreciation, 80% of it in 2023, 60% of it next year. QIP It's a really big thing for commercial property owners. I think a lot of short-term rental property owners don't realize they're a 39-year asset and that QIP does apply to their short-term rental. But the key is they've got to collect income as a short-term rental before they do any renovation, or QIP doesn't qualify.
Oh, got it.
Now, if you buy an office building that was previously an office building, you don't have to worry about it. It was previously a commercial property. They don't want to give this special tax treatment for building interior walls and extra plumbing and electrical. They don't want to give that to somebody unless it's a commercial business helping the economy, I guess. But they want it to have been in service as a commercial property before, and they're helping it get back in service, I guess. They don't want it to be a brand new asset, I guess.
Yeah. Disclaimer, still talk to the CPA.
Yeah. Anybody wanting to know all the minutia of this, just reach out to you or me. I'll give you the link to a recording we did in October. Every year we do a CPE event, and last year we had like 800 and some CPAs get credits by just listening to an hour and a half course. And we got like 5 out of 5 stars. Everybody loves the content because a lot of people don't understand. Even CPAs, they're really busy with other stuff. They have to know 77,000 pages of tax code. Depreciation is only about a half an inch or an inch. But we are a mile wide in that information, and having a resource is a really helpful thing. And I'm more than happy, if I don't know the answer, to reach out to corporate, because it's teaching me about stuff that if you or someone watching wants to know about it, I should want to know about it. So, reach out with any questions. But there is an hour and a half recording that I could provide you, and attached to it is the index with a timestamp where it talks about short-term rental. It talks about QIP. It talks about partial asset disposition. If we have time, it's worth 2 minutes. And they can go right to the part that's good for them. So.
What I'm going to do, I'm going to make sure I'll send this to all the listeners, all subscribers, and the newsletters, and also put them in the show notes. And if somebody has to reach out to you, where can they reach out to you?
Probably the easiest is by phone, which is 818. Thank you, by the way, 818-746-7558. My email is kind of confusing. It's Charles David, my first initials, CD, and then my last name, Barrett. You can see it on the screen, Barrett1@gmail.
I'll put that in the show notes, and I'll make sure people reach out to you about all the questions that you have about cost segregation, because it is not something that anybody can understand very easily.
I know.
It's about you don't know what you don't know.
Yeah. Oh, yeah. And it's very, very confusing. And it has its own terminology: bonus depreciation, QIP, PAD, partial asset disposition. All this stuff it's a lot. So, yeah. And I hope I can keep it simple. And I'm trying to learn it so I can explain it with layman terms, But
yeah, and thank you so much for your time, David. And I really, really appreciate it. You came on the platform and explained everything. But I know it's still very confusing, but I really appreciate it. Yeah. And
if we do it again, ask me about PAD. It's where you get money for what goes in the dumpster.
No,
old cabinets going in the dumpster is a write-off, and people miss it, and it only applies in certain situations. But we could talk about it. It takes some time. Yeah.
No, we'll do that one more time. That's for sure. That's a lot of information.
Okay.
Yeah. David,
somebody could do a 3-step. They buy a property at the end of the year, close on it, do the renovations the next year, and they can cost seg those two. And what goes in the dumpster during the renovation can be a crazy deduction that CPAs don't know the value of your old carpet, but if we study the building, we can tell you what went in the dumpster. It's just more write-offs. So.
Got it. Just save the money.
Save the money. You paid for it. The IRS says if you take it off your building and you put it in the dumpster, you should take it off your depreciation schedule and you should expense it. And a lot of people just miss that because they don't know the value of it. And we can stand behind it if it's audited. So CPAs don't like to do anything unless they can stand behind it. So they probably just leave it alone.
Perfect. All right, David. Thank you so much. And I'll see you another one.
Sounds good. Thanks, Aman.
All right.
Thank you for joining us on The Real Deal, a commercial real estate investing podcast, the show that covers everything to do with multifamily real estate investing to help you become an expert in your real estate ventures. We're here to help you create passive income and financial freedom so that you can achieve what you want whenever you want. We'll catch you next time on The Real Deal.